In this session, we are going to cover how to prepare projected financial statements for the purpose of doing valuation using discounted cash flow method. As we have understood that discounted cash flow method is one of the most reliable, dependable method for the purpose of valuation. But for discounted cash flow method, a lot of work has to be done. And the first thing that has to be done is to prepare the projected cash flow of the company for the future. So let's understand how do we prepare projected financial statements of a company. And what I am trying to do with you in this session is not only help you with preparation of projected financial statement for the purpose of discounted cash flow, but I am also trying to cover the same in a way so that you would also be able to prepare the projected financial for the purpose of capital expenditure, for the purpose of inorganic growth, for the purpose of organic growth, and for the purpose of budgeting control also. So the first step in making the projected financial statement is to do the estimation of project cost. So first do the estimation of the project cost. That means every component that will form part of the project you will need to identify, and you will also need to identify as to what is the amount that you're going to incur on each of those items. Say for example, land, cost of removal and disposal of old equipment, cost of preparing the site, cost of building, cost of main equipment and plant and machinery, preliminary expenses, pre-operative expenses, cost of other assets, provision for contingencies, margin for working capital, as much as provision for loss financing. And that is what is the step number one. After that, what you do the estimation of production and sales. So you have a company, you have a plant, or you have number of plants. You need to find out as to what is the capacity of each of those plants and how are you going to ramp up those capacities. So estimation of production and estimation of sales as to how much are you going to produce and how much are you going to sell. That is what you would need to estimate, prepare and work out at step number 2. Then you come to the step number 3, that is estimation of expenses. So in case of estimation of expenses, what you need to do is find out as to how much is going to be my material cost, how much is going to be my manufacturing cost, how much is going to be my personnel cost, how much is going to be my sales and administration cost. And that is what you will need to figure out. And for that, of course, you will have to have a definite set of assumptions which got to be absolutely realistic. After that, what you do the capitalization of pre-operative expenses. What are the pre-operative expenses? Pre-operative expenses are the expenses which are incurred by a company while the company is still in the process of implementing the project. So all the expenses which otherwise are operating expenses will need to be capitalized. That means all these expenses that would be incurred, all these operating expenses that would be incurred during the implementation of the project, all those expenses will need to be allocated to different assets on pro rata basis, and that is your step number 4. Then what you do, then you will need to look at the accounting of preliminary expenses. So what are the preliminary expenses? Preliminary expenses are the expenses which are incurred by a company in the process of incorporation of a company, as much as also expenses that are incurred in raising the capital for the company. And that is what you would need to figure out. At point number 6, you will need to calculate depreciation, right? So obviously, now that you know what is the value of all the assets that you have, what you need to do, you need to calculate depreciation. And please remember, depreciation has to be calculated for the purpose of making financial projections and otherwise as well under two different acts. So one is you calculate depreciation as per the Companies Act, and second you calculate the depreciation as per the Income Tax Act. I am sure a question may come to your mind as to why there are two different rates of depreciation under the Companies Act and under the Income Tax Act. So the question that may be coming to your mind as to why do we have to calculate depreciation twice, one as per the Companies Act and second as per the Income Tax Act. And please understand, the answer to this question of course is very simple. The objective behind Companies Act, the objective of provision, the objective of calculation of depreciation under the Companies Act is to help the company spread the cost of the fixed assets over the useful life of the asset, and that is the purpose of the under the Companies Act. Under the Income Tax Act, the purpose is to give an incentive to the industry for incurring more capital expenditure. So you would notice that the rates of depreciation under the Income Tax Act and Companies Act are not same. The rates of depreciation under the Income Tax Act are higher than the rates of depreciation under the Companies Act. Also remember, under the Companies Act you have two methods, straight line method and the written down value method. Under the Income Tax Act there is only one method, and that is written down value method, but the rate of depreciation under the income tax is higher. As a result of that, a company which is incurring capital expenditure will get more depreciation during the initial years. As a result of that, the taxable profit will go down. As a result of that, company will be paying lower taxes. That means company will have more cash in its hands from the operations of the company, and that is the reason why there are two different methods and two different methods and rates of calculating depreciation. Now, having done that, you come to the point number 4, step number 4, and the step number 4 is now what you do, you ascertain interest on term loans. I am sure you would remember when we discussed about the P&L, when we discussed about the balance sheet in our earlier session. You have to deduct the finance cost from your EBIT, that is earning before interest and tax, so as to arrive the figure of EBT, earning before tax. And so you need to calculate the interest on term loans. So whatever the term loans the company may have taken, the term loans can be from a bank or from a financial institution, or the term loan can be by way of a debenture, term debt can be by way of a debenture. So you will need to calculate the depreciation for the projected period. Say you are making projected financial statements for next 7 years, so you will need to find out as to how much is going to be the outstanding amount of these loans during these 7 years and what is the applicable rate of interest. Based on that, you will need to figure out as to what is the amount of interest that the company would pay, and you make a provision of that in your working. Now you come to point number 8, and in the point number 8, what you do, complete profitability up to the EBIT. So what you have done so far, you have arrived up to the stage of EBIT. So once you have the PBIT, and from the PBIT you minus the interest cost, what you get in your hand is your PBT. Now remember, for the purpose of getting the figure of PBT, not only you need to calculate the interest on the term loans, you also need to calculate your interest on the working capital. So as a business, you will obviously be having working capital. So for working capital, you would of course would take bank finance, and on those bank finance you will pay interest, and that is your interest on working capital. So what you will deduct from the EBIT is not only the interest that you will pay on the term loans, but it would also include the interest that you will pay on the bank finance for the working capital, and that is what you would do. For that, you will need to assess the working capital requirement and margin for working capital, and that is what you would need to do. So for ascertaining the working capital requirement and margin for working capital, what you will need to understand is the working capital operating cycle, maximum permissible bank finance, average utilization of drawing power, and computation of interest on working capital finance, and that is what you would do at the step number 9. And then of course you come to the step number 10, and that is you compute your profit earning before tax. So PBT or EBT, you call it PBT or you call it EBT, both mean the same thing. PBT would mean profit before tax, EBT would mean earning before tax, but ultimately the figure is same. So how do you understand the working capital operating cycle? So this is how is your working operating capital cycle. It starts with the supplier giving you the material, you converting that material into work in progress with the help of wages and salaries, overheads, and also convert the work in progress into the finished goods. Finished goods you sell it in the market, and they become your receivable, and when the customer makes the payment to you, they will give you cash, and you use that cash for the purpose of payment of wages and salaries, and also for making the payment to your suppliers, and the balance of course is your own cash flow. Now having crossed the stage and come up to the point of profit before tax, now what you need to do, you need to calculate the tax liability, computation of tax liability. How do you calculate the tax liability? Number one, you have calculated the depreciation as per the Companies Act. Please remember, for the purpose of arriving at the figure of income tax liability, the depreciation as per the Companies Act is not relevant at all. So therefore what you do, you add the depreciation as per the Companies Act back to the figure of PBT, and from the figure of PBT, now what you do, you deduct the depreciation which is as per the Income Tax Act, because for the purpose of computation of tax liability, it is the depreciation as per the Income Tax Act which is relevant. So from in the PBT you will add back the for the purpose of computing tax liability, you will add the depreciation computed as per the Companies Act back to the figure of PBT, and you will deduct the depreciation as per the Income Tax Act from this figure. And of course then you will make the adjustment for unabsorbed losses and depreciation. These are to be deducted, and also exemptions under various provisions of the income tax also will need to be deducted from the taxable income, so as to arrive at the final figure of taxable income on which you will pay the tax, and that is what you will do. And this is how you will compute the tax liability. So you will start with the figure of profit before tax, as I was telling you. Add the figure of depreciation under the Companies Act to the figure of PBT, minus the depreciation as per the Income Tax Act and the carried forward losses. What you get in your hand is the taxable profit. It is on this taxable profit that you will pay tax. So now what you have done, you have now once you know what is your tax liability, you deduct that figure of tax liability from the figure of PBT, profit before tax. What you get in your hand is your profit after tax, and I'm sure you know, you call it profit after tax, you call it earning after tax, you call it net profit, you call it net income. They all mean the same thing. Now what you do, now you ascertain your cash accrual, right? So because ultimately, remember, for the purpose of using the discounted cash flow model, what you need to do, you need to find out the free cash flows. So what your free cash flows are, your free cash flows will mean and they can be of two types. So free cash flow for equity and free cash flow for the firm, depending on what kind of valuation that you are trying to work out, whether you are trying to find out the value of the equity or you are trying to find out the value of the firm, you will use the cash flow accordingly. So if you want to find out the value of the firm, you will use the free cash flow for the firm. You want to find out the value of equity, you will use the free cash flow for equity. So that is what you will do. Now evaluate the project based on different techniques. So in case if it is an organic project, then you will evaluate the project based on different techniques. If it is a running company, then the question of evaluating the project based on the different techniques does not arise. But assuming that you are doing it for a greenfield project, then it is possible that having done all your computations, it is possible that the project does not seem to be viable, right? So in that case, you will have to make certain adjustments. What adjustments? So you will have to see as to how you can improve the cash flow. You will have to see as to how you can improve the earning from the project. So how will you do it? Number one, you will try and find out as to what all can I do for improving my revenues. Number two, you will try and find out what all I can do so as to remove the cost and thereby increase my contribution and thereby improve my return from the project so that the project becomes feasible. And then of course, taking these factors into account, you will prepare revised statements, and now you have the discounted cash flow available for 5-10 years, and then using the two-stage discounting model, you will find out the present value of all the future cash flows, and that present value that you arrive at for all the future cash flows, that becomes the value of your company. You divide that value of the assuming that you are doing it using a free cash flow for equity, you divide it by the number of shares, and that will give you the value per share of that company. In case if you are doing it for the inorganic or organic, in that case you will apply the net present value, or you will apply the internal rate of return for deciding whether to go for the project or not to go for the project. So friends, this is all that we have for this. These are all the steps that you have for the purpose of arriving at the projected financial statements. These are the steps that you would need to apply for arriving at the free cash flow for the purpose of valuation. And I'm sure once you do this, you would be able to find the value of a company or find the value of an equity. In this, there is one more aspect. When you talk in terms of discounted cash flow, remember there are two aspects that we need to take care. Number one, of course, is the cash flow, and number two is the cost of capital. So cost of capital is a topic that we will discuss some other time. So with this we sign off. Thank you.